Welcome back to the deep dive. It feels like the business world is just constantly changing, doesn't it? Almost dizzying. New trends pop up, breakthroughs happen, huge shifts. It feels like every day. And trying to keep up with every single headline, every report, well, it can be a lot. And that's really why we're here. This deep dive, it's all about cutting through that noise. We're digging into the most critical insights from recent market-moving news. We'll cover the economy, the booming AI scene, big corporate moves, even some personal finance tips. Our goal is just to give you a clear picture of what's happening now and, importantly, what it could mean for you. So let's get into it. We've got a really interesting mix today, everything from tech giants and their latest gadgets to how AI is actually reshaping cities and real estate. We'll also look at how some big companies are handling their money and what steps you might think about for future economic shifts.
Yeah, some really compelling stuff to unpack. Okay, let's jump right into our first big topic, the economy. It seems like it's always shifting. The Labor Department just released some numbers, kind of a reality check.
And Jamie Dimon, JP Morgan CEO, he recently said the U.S. economy is weakening. How much do these new numbers back that up? Is it just a blip or something more?
Yeah, it's smart to connect those two. The Labor Department's report definitely adds weight to what Diamond is saying. We saw a pretty significant downward revision in non-farm payrolls. That's basically jobs outside farming and some government roles. The latest numbers show about 911,000 fewer jobs reported for the year through March 2025 than they first thought.
Wow, nearly a million jobs. 911,000 is. That's quite a revision.
It is. And if you look broader over the past, say, 16 months, the total reduction in job growth is closer to 1.2 million. So it's a pretty substantial adjustment.
Okay, so for people listening, what's the real takeaway here? It's not just stats changing on a spreadsheet, right?
Exactly. The key thing is this isn't just a number. It signals a real recalibration of the post-pandemic job market. Power is shifting a bit back towards employers, maybe less so in those super specialized tech jobs, but elsewhere. What it means for you is probably less aggressive wage growth, maybe more competition for jobs in mainstream sectors. A softer job market affects confidence.
Right, makes people maybe hesitate to spend big.
Precisely. It hits consumer confidence, career prospects. It can directly impact your household budget, your financial plans.
Makes sense. And speaking of hitting our wallets, inflation reports are coming out this week, and prices, well, they're still climbing. What's keeping them up, and how do those tariffs we keep hearing about fit in?
Well, we're expecting the August inflation numbers to show about a 0.3% increase month over month for both headline and core CPI, and PPI too. The annual headline CPI rate, that's expected to hit 2.9%, which would actually be the highest since January.
Okay, 2.9%. So what's pushing that?
What's really interesting, or maybe concerning, is that a lot of this increase seems tied to tariff-sensitive goods. Think cars, furniture, clothes,
Right.
rather than, say, services prices shooting up across the board.
So it's tangled up with trade policy then, if it's mostly those tariff-sensitive goods? And there's that big legal fight over tariffs still going on, isn't there?
Absolutely, yeah. It connects directly to that ongoing political and legal battle. The Supreme Court actually agreed to hear the Trump administration's appeal on an expedited basis in November.
Expedited, so they're moving fast.
Relatively, yeah. And this appeal, it challenges lower court rulings that said a lot of these really broad tariffs were, well, illegal. And the stakes are massive. Treasury Secretary Scott Bessent warned about potential refunds, maybe $750 billion up to $1 trillion if the court rules against the administration.
Wait, up to $1 trillion in refunds?
Potentially, yes.
Yeah.
That's a huge amount. Think about the impact not just on government finances, but importers might get big refunds back, which could then affect how they price things later on.
Okay, $1 trillion is hard to even wrap your head around. So with jobs looking softer, inflation tricky because of tariffs, this legal battle, what does it all mean for the Federal Reserve? What's their next move likely to be?
The market seems pretty convinced. Expectations are high for the Fed to cut benchmark interest rates at each of the last 3 meetings this year. So September, October, December.
3 cuts.
That's the expectation. There's even some chatter about maybe a 0.5 percentage point cut next week, though that might be less likely. The thinking seems to be that the Fed might try to look through these price increases caused by tariffs, see them as temporary, and focus more on that weakening jobs market we talked about. So basically, prioritize supporting employment and growth over fighting inflation that's being driven by trade policy. It's a tricky balancing act.
It really is. So yeah, whether it's job numbers, inflation, trade wars, these big economic forces, they aren't just news headlines. They directly hit your purchasing power, your job situation, how you think about investments. It's the world we're living in. Okay, let's shift gears a bit. Moving from the big economic picture to another huge force, AI. The AI revolution. It feels like it's touching everything, even reshaping our cities, our real estate markets. How is this huge demand for AI talent actually impacting where people live and work?
It's pretty dramatic, actually. The number of tech workers with AI skills, it jumped over 50% just from mid-2024 to mid-2025. We're talking about 517,000 workers across U.S. and Canada.
60% in 1 year. Wow.
Yeah. And they're really concentrated in the big hubs. San Francisco Bay Area, CBRE's Colin Yasukochi called it ground zero for the AI revolution. Plus, New York City, Seattle, Toronto, D.C., the top three cities alone have like 35% of all these AI tech workers.
Okay, so tons of growth clustered in a few key places. How does that translate to real estate?
Yeah.
Offices, apartments?
Well, a key thing is that AI work seems to be predominantly in-office work, often 5, even 6 days a week.
Really? Not remote?
Less so than other tech sectors, it seems. So that's boosting demand for office space in a big way. In San Francisco, for example, something like 1 out of every 4 square feet leased in the last 2.5 years went to an AI company.
Okay, so offices are hot in those areas. What about where people live?
Huge impact on residential, too. Apartment rents are up in all those top AI markets. Manhattan saw over 14% growth from 2021 to 2024. D.C., over 12%. Seattle, over 7%. San Francisco, almost 6%.
So rents are climbing fast.
They are, but here's a sort of counterintuitive point. Because tech salaries, especially in AI, are so high, these markets are still relatively affordable for those specific workers, like tech workers in the Bay Area or D.C. might only be spending around 19% of their wages on rent, even with those high prices.
Huh. That's fascinating. So for the AI workers themselves, it's manageable despite the surge. But the insight here then is that this AI boom, it's creating almost two different realities in these cities, isn't it? What does it mean for everyone else living there?
That's exactly the critical question. You nailed it. For everyone else, the non-AI workers, residents who are already there, they face rapidly rising living costs. It risks widening that socioeconomic gap. These cities become magnets for the high-skilled, high-paid AI crowd, which boosts the local economy in some ways, sure, but it can also price out essential workers, artists, long-term residents, people not tied to that tech boom. It raises big questions about, sustainable urban growth.
A really important point to think about. So beyond just attracting talent and shaping cities, how are the big tech companies actually, making money from all this AI hype? Let's look at Google Cloud. What's their playbook?
Yeah, Google Cloud's CEO, Thomas Kurian, gave some pretty interesting details. He flat out said Google has made billions using AI already. And get this, their customer demand backlog, basically, signed deals for future work, is $106 billion. And that backlog is growing faster than their current revenue.
106 billion. That's
Yeah.
staggering. And it points to future growth.
Exactly. They expect most of that to turn into revenue over the next couple of years. So how do they monetize? Mainly 3 ways. First is consumption. Customers pay based on how much they use. That could be paying per GPU or TPU, those specialized AI chips, or paying by tokens for using AI models, which is like paying per unit of text processed. Or for, say, customer service AI, they might pay based on deflection rates, how many calls the AI handles without needing a human.
Okay, pay as you go. What else?
Second, subscriptions. Straightforward monthly fees per user for products like Gemini or Google Workspace AI features. They even have premium tiers, like a Google AI Ultra for nearly $250 a month, giving access to their best stuff.
Right, the classic subscription model. And the third?
The third is upselling. The idea is a customer starts using an AI service, maybe just dipping their toes in, but that leads them to use more of Google's other cloud products, storage, databases, analytics. So AI becomes a gateway, increasing the customer's total spend with Google Cloud.
Gotcha. So consumption, subscription, and using AI to pull customers deeper into their whole ecosystem, that really clarifies how they turn the tech into revenue. It's not just about the cool factor.
Precisely. It shows the practical business engine behind the AI revolution.
Hmm.
And it's not just Google. Microsoft just signed a huge multi-year, multi-billion-dollar deal with Nebius Group for AI infrastructure. The demand for the underlying hardware, especially GPUs, is just intense across the board.
Right, the whole infrastructure piece is booming. Okay, let's pivot now to some specific company news and consumer choices, starting with Apple. They just had their big iPhone event. What came out of that and what's going on with their pricing, especially with those tariff pressures we talked about earlier?
Yeah, Apple rolled out the new lineup. There's the iPhone 17, the sort of entry-level one, starting at $799 with a better display. Then a new model, the iPhone 17 Air Thin Light Titanium Body, starts at $999. That one replaces the old iPhone 16 Plus. The iPhone 17 Pro, that one got a price hike. It's now $1,099, which is $100 more than the 16 Pro. But to be fair, it does start with more storage now, 256 gigs.
Okay, $100 bump on the Pro. What about the Pro Max?
The Pro Max price stayed stable, starting at $11,199 plus. And they added a huge new 2 terabyte storage option for that one.
2 terabytes on a phone. Wow. So why the price increase on the Pro? Is that the tariff impact?
It seems directly linked. Apple themselves said they expect over $1 billion in tariff costs just this quarter.
$1 billion.
Yeah. So that price bump, plus charging more for storage upgrades, like it costs an extra $200 now to get 512 gigs on the new Air model that helps them offset those costs. They've also been shifting supply chains, moving more production out of China to places like India.
So strategic pricing and supply chain moves to handle costs. What about new features, especially AI?
They did announce some AI-related things. The new AirPods Pro 3, $249, they'll have real-time translation features. The new A19 Pro chip inside the iPhones has specific machine learning accelerators, and they emphasize it can run large language models, or LLMs, right there on the device.
Local LLMs, okay. Anything else?
The new Apple Watch, Series 11, starting at $399. That's supposed to get a new high blood pressure monitoring feature, powered by machine learning, though that one's still pending FDA clearance.
Interesting. So some definite AI sprinkles in there. But how was the overall reaction? Was it seen as revolutionary?
It was a bit mixed, actually. Some analysts, like Daniel Newman from Futurum, called the launches mostly incremental, not huge leaps. And Amit Dariani over at Evercore pointed out that for most people upgrading their iPhone, AI features are still, lower on the priority list than things like better battery life or a nicer screen.
Right. So the insight here seems to be, even as companies like Apple push AI features, for a lot of us, the core things still matter most. And maybe the real AI revolution on our phones is still coming, forcing Apple to focus just as much on managing costs, like those tariffs, as on flashy new tech.
I think that sums it up perfectly. It shows that balancing act, pushing innovation, dealing with real-world cost pressures like tariffs, and meeting consumer expectations where they actually are, which, for many, isn't primarily about AI yet. It shapes the product you end up seeing and buying.
Fascinating stuff. Okay, moving beyond tech giants, let's look at a couple of other well-known brands navigating customer loyalty and brand image. First up, Starbucks. How's that turnaround effort going under CEO Brian Niccol?
Well, it's definitely been a story with twists and turns. Niccol just hit his one-year anniversary as CEO, and sales and customer traffic are still shrinking, which isn't ideal. But Niccol insists the turnaround plan is actually ahead of schedule. They're pushing initiatives like the Green Apron Service program, trying to recapture that traditional coffee house vibe. And they did have their best ever U.S. sales week recently, driven by the return of the pumpkin spice latte, which is always huge for them.
The PSL effect. But shrinking sales overall.
Yeah.
What are the challenges or criticisms?
There have been some bumps. Things like mandating baristas write on cups with Sharpies again, which got some pushback. There was also the controversy around requiring corporate employees back in the office, while Niccol himself got an exemption.
Ooh, that probably didn't go over well.
Likely not. And the stock price has actually fallen about 7% during his first year. So it's definitely mixed. They're also looking at maybe bringing in partners for their China business, which is valued around $5 billion, so reevaluating big parts of the strategy.
Sounds like they're still figuring out that balance between change and tradition. Which brings us perfectly to Cracker Barrel. They had a recent logo issue that really highlights the power of, well, customer reaction and tradition, right?
Oh, absolutely.
Yeah.
This Cracker Barrel story is a fantastic example of that tension. They actually had to suspend all their restaurant remodels and switch back to their old logo.
All of them. Why?
Because of what they called a firestorm of backlash on social media after they tested a new modernized logo and some remodel elements. Even President Trump weighed in against the changes.
Wow.
And the really striking part, this huge reaction, this complete halt to the program, was triggered by customer feedback from just 4 test locations.
Only 4 stores.
Just 4. It really shows how deeply customers, especially for a brand like Cracker Barrel that trades on nostalgia and tradition, feel connected to the brand identity. Messing with that, even with good intentions of modernizing, can backfire spectacularly if you alienate that core base. It underscores the power of that brand heritage.
Yeah, that's incredible. Both Starbucks and Cracker Barrel really illustrate that tightrope walk companies face. trying to modernize and stay relevant, but without losing the connection to their loyal customers, especially when those customers are very vocal.
Okay, we've covered big companies, the economy. Let's bring it back to personal finances now. Thinking about the future, what's the latest news on Social Security? And more importantly, what can people actually do now to prepare?
Yeah, the latest Social Security projections are definitely worth paying attention to for anyone planning long term. The estimate now is that the main trust fund could be depleted by the end of 2032. 2032? That sounds soon. Didn't it used to be 2033?
It did. It moved up by a year, partly attributed to the impact of tax cuts in Trump's budget bill, reducing payroll tax revenue going into the system. But, and this is a really important point, depleted doesn't mean benefits stop entirely. If nothing changes by then, the system could still pay out about 77% of promised benefits from ongoing payroll taxes. So a significant cut, but not zero.
Okay, 77%, still a big hit, but not zero. What might Congress do to fix it before then?
There are a few main levers they could pull. They could change the benefit formula itself, maybe calculate it differently. They could raise the payroll tax rate that workers and employers pay, or they could raise the full retirement age again, which is currently 67 for most people now.
Right, those are the usual suspects. So for you listening right now, what are the practical steps? How do you plan for this uncertainty?
Good question. A few concrete things. First, get your personal Social Security statement. You can usually get it online. Understand what your estimated monthly payout might be at different ages. You get your full benefit at 67, but it increases by 8% each year you wait, up to age 70.
Okay, know your numbers. What else?
Second, maybe plan for the worst-case scenario, or at least for a reduction. Do some math. Combine your estimated Social Security benefit, maybe even model it at that 77% level, with what you might draw from your own savings. A common guideline is the 4% withdrawal rule from a diversified portfolio. And honestly, working with a financial advisor can be really helpful here. They can help you model different scenarios, factor in potential benefit cuts, and build a plan that gives you more confidence.
That makes a lot of sense. Doing that kind of proactive planning, even if the worst doesn't happen, probably provides, as you said, some real peace of mind for the future. All right, finally, let's touch on some investing insights. Jim Cramer often talks about strategies that give companies an edge. What's his take on share buybacks, especially right now?
Yeah, Cramer often highlights aggressive buybacks as giving companies an edge, particularly when the economy might be slowing down. He likes to point to what Goldman Sachs analyst David Kostin calls the buyback aristocrats.
Buyback aristocrats? What are those?
These are companies that have consistently bought back their own stock, reducing their share count by at least 1% a year for, say, 9 out of the last 10 years. Think companies like Apple, Wells Fargo. They've been buying back maybe 4% of their shares annually. Cramer's view is that these buybacks effectively drain the excess supply of stock from the market, which can help support the share price. And maybe more importantly, it signals that management is confident the stock is a good value.
That's an interesting perspective. Confidence signal supports the price. But couldn't you argue the opposite sometimes? Like maybe that money should be going into R&D or expansion, especially with big trends like AI needing investment. Is there a downside?
That's a really sharp point, and it's a constant debate in finance. Cramer's take on the aristocrats suggests it's strategic. In a slowing economy, maybe returning capital to shareholders through buybacks is the smarter move if growth opportunities look less certain, or if management truly believes the stock is undervalued. So it might signal a more cautious outlook, or a prioritization of shareholder return over immediate aggressive expansion. The insight for you as an investor might be to see consistent buybacks as a sign of stability and management commitment, but yes, absolutely question if it's coming at the cost of vital long-term investment, especially in fast-moving sectors. And just quickly, on a different note, Cramer also recently mentioned an under-the-radar growth stock he likes, Casey's General Stores.
Casey's, the convenience store chain.
Yeah, they apparently just had a terrific quarter, beating expectations on earnings and revenue. What's interesting is the stock is up about 36% this year already, even though management kept their full-year guidance the same. Just some real underlying strength there that the market likes.
Interesting. So understanding things like buyback strategies or spotting companies maybe punching above their weight like Casey's, it can definitely help you make more informed investment choices, especially in these kind of mixed economic conditions. Well, we certainly covered a lot of ground today, from the big picture of the U.S. economy, jobs, inflation, those tariffs, to the really deep ways AI is starting to change industries and even our cities. We looked at how companies like Apple, Starbucks, Cracker Barrel are navigating costs and customer loyalty, and we touched on some practical steps for thinking about your own financial future with Social Security and investing. It's clear things are moving fast, and that leaves us with the thought to maybe chew on. As technology keeps accelerating and these economic forces keep swirling, that growing demand for specialized AI talent we talked about, could it create an even bigger divide in affordability in our cities? Will it fundamentally reshape who gets to live and work in the innovation hubs of the future? Something to ponder as we all try to navigate these shifts together.